I'm Beth Ewan with Franchise Times. We're at the Restaurant Finance and Development Conference, and I'm here with Kevin Burke of Trinity Capital. We're going to talk about the M&A market today. So Kevin, give us an overview of your view of the mergers and acquisition market in the franchise space this year.
Well, we've had a record amount of activity, particularly in the chain restaurant sector, and a lot of that is driven by efficiencies that large operators have been able to extract out of their smaller acquisitions, continued low interest rates, and a little bit of growing consumer confidence during the year. After some difficulty with commodity markets and a very poor first quarter weather-wise, the year's shaping up to be a little bit better in transactions than last year, although casual dining continuing to still suffer.
What sector amongst the restaurants are you seeing the biggest activity and the biggest valuations?
I think that the largest valuations are in the quick casual, fast casual space, but the most activity has been in chain restaurants, particularly in QSR. And a lot of companies have changed hands because you have a lot of septuagenarian and octogenarian owners who are ready to retire. You've got record high interest in real estate, and there's been a lot of real estate sales and general liquidity events by owners who have been in a concept for perhaps 15, 20, 25, 30 years and looking for an exit.
Now we're just about getting to the end of the year, a couple months to go. What are you seeing in terms of the end of the year wrap up? Do you feel like it's going to be a record level of activity compared to pre-crash, or not quite yet?
Well, I think that in our space it will be, simply because there are a lot of areas in consumer activity that have not recovered as well. And a lot of families are saying, look, restaurants are a place where we're going to spend some money. We might cut back in other areas. So while we went down 2 billion visits from 2012 to 13, from 63 billion visits to 61, this year we'll probably be flat at 61, but we've taken a little bit of price in the industry, and I think it does show the consumer, willing to dine out at the expense, perhaps, of other consumer spending.
Interesting. What about next year in terms of deal activity? Do you think it's going to be a big year, or are things slowing down a bit for those operators who want to have a financing event?
I think that the level of activity will really hinge on interest rates, on consumer confidence, commodity and gasoline prices. Clearly, we've seen gasoline prices as low as $2.49 in Houston this week, breaking $3 in the Bay Area, nationally around $2.75. That's a tremendous improvement, which is, from all accounts, producing a good effect throughout the industry, particularly in QSR, fast casual, and family dining. I think that next year we'll see the same level of activity we have now, unless we have a geopolitical event or a unforeseen economic event that scares the consumer and has people retreat from meal occasions away from home.
It sounds like those low energy prices, low gas prices are going to feel a little surge of confidence here straight through the holiday season. So that's good timing at least.
That's great. That is true.
Absolutely. I'm Beth Ewan with Franchise Times. Thank you so much to Kevin Burke with Trinity Capital.
Thank you.